Welcome to Second Take, the show that focuses on the issues behind the news. The world's attention is currently fixed on the Eurozone crisis and renewed concerns about global growth. Terence Creamer joins me to discuss the implications for South Africa, especially the country's embattled manufacturing sector. Terence, welcome to Second Take. There's growing concern locally about a possible fallout from the Eurozone crisis. What are local commentators saying?
Well, I think the main message is that we know that we live in an interconnected world, and any decline in the growth rates of Europe or North America and China or anywhere in the world is going to have implications for this economy. Now, South Africa during the 2008-2009 Great Recession really didn't escape that crisis at all. We went into recession ourselves and we lost a full million jobs. That was about the worst in the rest of the world. If you look at the rest of the world and how everyone else coped in terms of the job losses, South Africa was amongst the most volatile in terms of job losses. And with the Eurozone crisis, coming to a head this month, because European countries are having to come to terms with how they're going to deal with the Greece and stop that Greece crisis from becoming a contagion into places like Italy, Spain, much bigger economies that are basically seen as too big to fail, but also too big to bail out. So they're looking at a way to deal with this crisis at the moment. There's these votes in the 17 Eurozone countries that are taking place. You saw the German vote yesterday. And the Europeans are having to see how they're going to capitalize this bailout program through the European Stabilization or European Financial Stabilization Facility. So we into this mode of sort of how we're going to deal with this crisis, and South Africa is having to also look at how it's going to cope with maybe the fall off in demand for its exports from Europe and from North America, which is looking fairly anemic at the moment. And it's also looking at whether in this interconnected world, whether we shouldn't have some role to play in supporting Europe. The sort of tables have turned in sort of world real financial politics, and we're having to see actually the developing countries thinking about bailing out the developed countries. So there's talk about recapitalizing the IMF and really boosting its financial firepower. And South Africa, along with its BRICS partners, Brazil, Russia, India, and China, are looking at, have agreed that if there is a recapitalization, we will follow our sort of shareholding voting rights or our shareholding rights, and we will recapitalize to that point. For South Africa, that's not a lot of money. It is hundreds of millions of dollars. But for others, the bigger your shareholding, the more you have to contribute. And others do have more capacity, especially China, to do so. So there's this feeling that, we need to have some sort of credible institution that there's a whole series of little crises that is becoming a massive one, and there's a feeling that there's still more to come, and we maybe need some more financial firepower to deal with it so that it doesn't morph from a Greece crisis into a European-wide banking crisis, which will then become a global financial crisis. And this time around, there's probably less monetary and fiscal space in a lot of these other countries to actually deal with such a crisis. So I think everyone's trying to knock heads together and come up with some sort of solution to avoid the worst. The best case of a V-shaped type recovery from the 2008 global or Great Recession has, averted us, but now we're trying to avert the worst of a sort of double dip.
There's particular concern about the domestic manufacturing sector. What are local practitioners saying in this area of the economy about prospects?
Yes, I think the manufacturing sector has really been at the sort of leading or bleeding edge of all these crises that are taking place. We saw many of the job losses during the 2008-2009 recession in South Africa really took place in that sector. And then it's been the big swing factor in terms of our growth rates this year. So in the first quarter, good manufacturing recovery, we had good GDP growth outcome, along with, obviously being buoyed by the commodity price and the commodity demand comeback post the sort of recession. Then in the second quarter, we had that collapse in the manufacturing output, which dragged our GDP right down again. In fact, manufacturing is right down to something like 15% contribution to GDP, which is well off the peaks of around, it's closer to 30%, 25 to 30%. So you can see we've had this massive deindustrialization over the last decade and a bit in South Africa. And there's concern now that the third quarter is going to be dismal as well. We had the strike action during that period. So probably manufacturing's contribution to GDP is going to be a drag again in the third quarter. And then we go into the Christmas holiday season. So, it's all round not looking very healthy. And manufacturing in particular has been raising, its voice for a number of years now. And it's becoming a much more organized voice in the form of the manufacturing circle, which started off as, say, 11 companies, mostly large JSE-listed manufacturers, and has morphed into something much bigger over the last few years and months, and is now its surveys now account for nearly 60 companies. So it's becoming a more powerful voice, and that powerful lobby is saying, look, we need some sort of help from the monetary and fiscal authorities. And they particularly have been homing in on the monetary authorities, saying we need this rand to weaken. We can't have a rand at around the 750 level. We need a much weaker rand, closer to the 859 level, to really be competitive as productive sectors. They're saying not just as manufacturing, but as agriculture, as mining, and as tourism. We really need a more competitive rand. And also we need a far more stable rand. Now, to achieve that's very difficult. The Reserve Bank last week had its monetary policy, interest rate decision. And in that interest rate decision, they looked at the rand rapidly weakening. We saw the rand moving from the mid 750 to close to 850. It's a 28 month low, and it was all done within a matter of days. So they basically were worried about the inflation implications of that weakening rand, and therefore I think decided against expectation in some ways to hold interest rates. Now the manufacturing sector is saying, that's the worst thing you could have done. We needed to actually send a signal that we want this rand weaker. We should have lowered our interest rates, created that monetary loosening so that it really fell to a lot weaker level, so that when the tailwinds for a stronger rand, which there are a number of tailwinds for that because of the commodity prices and the demand, when that starts coming back into the equation, because markets tends to correct and then overcorrect, we need to be able to have a new level of around mid-eights. But they said that was a missed opportunity, and we now are going to have to look to the fiscal authorities to provide some sort of stimulus. And that would be a signal. The next signal on that is going to have to be coming out from Pravin Gordhan on 25th of October next month, so that we can see whether South Africa's got any stimulus firepower left.
Terence, finally, does South Africa have any more capacity left to stimulate the economy?
Well, it's a good question, because I think it's the one that's going to be taxing the mind of Pravin Gordhan, the finance minister, over the next few weeks, because we don't necessarily want to go into that space. We've got an official policy, both within the new growth path, as well as what we've seen in the last medium-term budget policy statement and in the budget in February, of starting to move towards fiscal tightening and monetary loosening. Now, with the MPC's move last week to not decrease the interest rates, it's almost a signal that that holding pattern was almost a tightening signal. They're nervous about inflation, and especially imported inflation. But on the other hand, Jill Marcus made it very clear that that's needing to err on the side of sustaining growth. So I think there's not really much view that there's going to be many more interest rate hike decisions in the near future. In fact, a lot of economists are pushing hike decisions right off the agenda till late next year, if at all next year. And she also indicated that we could see further interest rate cuts. So there is that potential for further monetary loosening. And we aren't like the rest, many of the developed countries where they're at zero interest rates. So we're not at the point where we've got no financial firepower, but we are nervous about the inflation implications there. Then on the fiscal side, we're not in the situation of many of the other countries where there's just very limited fiscal space. We have gone from surplus into fairly substantial deficit, but it seems that there's still space to increase that deficit ceiling. And I think that's what the National Treasury will be thinking about over the next few weeks. And I think that they'll particularly be wanting to direct any fiscal stimulus towards capital investment. So not, not more consumption. We've already seen massive increases in the salary bill in governments. Okay, those salaries are important to be sustained, and that creates demand in the consumer economy, which has really been the key driver of economic growth. But I think if we see any more stimulus, it's really going to be about infrastructure. And it gels quite nicely with what President Jacob Zuma has done in terms of setting up this infrastructure commission. So we're saying, yes, we want to, if we're going to add stimulus into this economy, it has to be in infrastructure. The biggest problem in South Africa is we haven't really had good capacity or good track record in delivering on these capital programs. So we've been better at just boosting the consumptive side of the spendings, and we haven't really done the capital side. But I think that with those two legs in place, plus the tightening around the tender rules that is coming out of National Treasury, plus the view that we need to try and crowd in manufacturing around that, the planets are aligning, I think, for more fiscal stimulus for a more prolonged period, rather than the tightening that we were probably going to be expected to hear about in the medium-term budget policy statement. But we'll have to wait till October 25 to find out whether I'm correct.
Terence, thank you very much. That is the Second Take show for this week. Thank you for watching, and join us again next time for more news analysis.